Good day everyone, I'm Patrick. So far, we've had a phenomenal first quarter. Equity markets recorded positive returns year to date, led by strong inflows, improving economic data, and lower number of COVID-19 cases globally. It is also encouraging to see more clarity from the new Biden administration, especially towards climate control and the mass vaccination rollout in many countries. This leads us to have more confidence that most developed and emerging countries are moving towards recovery, revitalized, and renewal environment that we have been anticipating. Equity sentiment undertones continue to be positive, although we have seen some volatility in the last few weeks. Rising bond yields of late due to higher inflation expectations has led to the recent global equity market correction. We will view this as temporary, as the facts are the following. Number one, there are no real signs from the data that real inflation is rising. 2. Bond yields are actually rising as the price in better economic recovery, i.e. better growth prospects for the future. For example, the recent approval of the $1.9 trillion fiscal stimulus is actually positive to ensure that the US recovers on a more even path. And last but not least, the US Federal Reserve has signaled that they are in no hurry to raise interest rates and will want an orderly increase in bond yields in the future, signaling that they have policy tools to mitigate any major disruption to the bond market. The investment environment for Asian equities continues to remain favorable. We foresee an economic recovery taking place, the rollout of vaccines coupled with continued monetary and fiscal support. Emerging markets like Asia are attracting foreign inflows because growth is higher and markets are less overowned, and currencies are on a good footing and valuations are reasonable. US-China relations could be less thorny and less volatile going forward. Washington has just reaffirmed its One China policy on Taiwan, and this is a promising start before dialogues on other issues like trade and investment restrictions. In ASEAN, we are taking a contrarian positive view that these markets should do well this year. Why? Because most ASEAN markets were underappreciated in 2020 and therefore exhibit deep value opportunities. It provides opportunities for clients who seek long-term value in tourism, e-commerce, and commodities, which we think will do very well this year. In local markets, we remain constructive on Malaysian equities as we look towards reopening of the economy post-MCO. With the vaccine rolled out, the economy will start to recover, which will eventually lead to the broadening out of the rebound in corporate earnings. The Malaysian equity remains cheap, a big laggard year to date, and we think the foreign selling are overdone. Opportunities abound in our small cap and balanced income funds, which continue to provide growth and income opportunities to our clients. As they say, bull markets don't all go up in one straight line. It's only natural to see the recent correction after a strong rally since March 2020. We're aware of near-term concerns on higher inflation that will contribute to recent volatility. Don't forget that the key focus should not be on inflation, but on growth and recovery of Asian economies. The revitalization of ASEAN markets and a renewed 21st century where the focus is on ESG, biotech, and other renewable themes. In short, the 3 Rs. In conclusion, take advantage of the recent correction to stay invested. Stay safe everyone, and thank you.